In prior videos, we learned about the accounting cycle steps 1 to 9 and the worksheet for service business and merchandising business. In addition, we learned about financial statements, the income statement, the statement of owner's equity, and the balance sheet. In this video, you'll learn about the classified financial statement layout, which makes it easier to calculate financial ratios and compare companies. The starting point for the preparation of the financial statements is the worksheet. Here's a worksheet for Whiteside Antiques. In practice, you would likely use an accounting software to record adjustments and print out an adjusted trial balance. However, in this class, we'll use the worksheet because it teaches you what the system will do for you in the future. Accountants often participate in accounting software implementations and test the software program functions as intended. Why do you have to test the system? Many companies customize accounting software so that it can work with other systems that the company uses. So accountants test that all of the interfaces between systems work and that the transactions are recorded correctly. That is why you're learning all of the steps involved in the accounting process so that you will know when systems are not working correctly. As a reminder, to complete the worksheet, we first enter the account names and balances from the general ledger, which is also called the record of final entry, into the first 3 columns of the worksheet. We make sure that we entered all numbers correctly by summing up the debits and credits and double checking that they balance. Next, we record the adjustments for expired rent, used supplies, depreciation, accrued salaries, deferrals, merchandise inventory, and other accruals. Again, we make sure that the column totals balance, like they do here for this worksheet for Whiteside Antiques. Then we prepare the adjusted trial balance by combining the trial balance and the adjustments. And finally, we prepare the income statement and balance sheet. Now we're ready to talk about classified financial statements. Classified financial statements are financial statements that group similar accounts together within those statements. This makes it easier to understand the financial statements and to calculate financial ratios. Let's go through each statement step by step. Let's start with the classified income statement, also sometimes called the multi-step income statement. The first section is the operating revenue section. In this section of the financial statements, we show the revenue earned from normal business activities. For service business, operating revenue would be the service revenue that the company earns from providing services. A merchandising company would report as operating revenue the revenue it earns from selling merchandise. Other income is presented separately near the bottom of the financial statement. Examples of other income include income from interest, rent, and gains resulting from the sale of fixed assets. Why is operating revenue shown separately from other income, you might ask? Well, when investors evaluate financial statements, they want to know how successful the business is in its core operating activities. Other income might not be recurring and could give a completely different perspective of the business. That is why operating and non-operating activities are separately shown on financial statements. The second section of the classified income statement is the cost of goods sold section. However, this section only applies to merchandising and manufacturing companies, but not to service companies. Why? Well, service companies sell services, do not hold inventory, and don't buy merchandise for resale. This section only applies to merchandising and manufacturing companies. This section calculates the cost of goods sold by starting with the beginning inventory, adding the net delivered cost of purchases, which are the purchases less returns and allowances and discounts, and subtracting the ending inventory. The ending inventory, by the way, is also shown on the asset side of the balance sheet. After subtracting cost of goods sold from sales, we arrive at gross profit on sales. Frequently, investors and analysts calculate the gross profit percentage, which is the gross profit on sales divided by sales, or in this case, $219,030 divided by 549,150 equals 40%. This represents the markup of the merchandise. Put another way, for every 60 cents the company spends on merchandise, it will make $1 in sales. The gross profit has to be sufficient enough to cover all other operating expenses. The third section of the classified income statement is the operating expense section. Operating expenses are expenses that arise from normal business activities and are typically split into two categories: selling expenses, which relate directly to the marketing, sale, and delivery of goods, and general and administrative expenses, which are necessary for business operations but are not directly connected with sales functions. Merchandising firms often use warehouses to store inventory. These firms would have an additional operating expense category called warehouse expenses. Expenses that are not directly connected with business operations appear in the other expenses section. Net income from operations are calculated by subtracting total operating expenses from the gross profit on sales. Investors will want to know whether core functions are profitable and, as a percentage, how much is left from all sales dollars once all expenses are paid. For this business, we calculate net income from operations, $51,196.20, divided by net sales, $549,150, which equals 9.3%. In addition, investors will want to know if the company operates the business efficiently by calculating as a percentage how much the business spends on operating expenses. For this business, we calculate $167,833.80, which are the total operating expenses, divided by net sales, $549,150, which equals 30.6%. And of that, 17.3% for selling expenses and 13.3% for G&A expenses. We don't really know whether 13.3% for G&A expenses is high or low unless we compare the financials for this period to a prior year, the forecast for this year, or to another company in the same industry. After adding other income and subtracting other expenses, we arrive at net income. It's common for companies to provide financial statements to others, especially if they're applying for payment terms. That means that you must provide financial information about your company, but you might not want to disclose all of the details, such as how much rent the company pays, how much you pay in salaries. You might be disclosing more than you want to. You certainly don't want to give an outsider the roadmap for running your business. In those cases, it might be enough to provide a condensed income statement. A condensed income statement provides the minimum necessary information, but not more than that. Now let's move on to the statement of owner's equity. Why do we prepare the income statement first? Well, the statement of owner's equity requires net income from the income statement. You can't complete the statement of owner's equity without calculating the net income first. The statement of owner's equity begins with the beginning capital of the year, adds net income, and subtracts withdrawals to arrive at the ending capital. The next step after preparing our classified income statement and the statement of owner's equity is to prepare the classified balance sheet. Most large companies present comparative condensed income statements and balance sheets. The Security and Exchange Commission, SEC, requires most publicly traded corporations to present 3 years of income statements and 2 years of balance sheets. This provides users information that helps assess the progress in profit and financial strength of the company. Just like we grouped our income statement by categories, cost of goods sold, selling, and operating expenses, we group categories of assets and liabilities. Current assets consist of cash, items that will normally be converted into cash within 1 year, and items that will be used up within 1 year. Current assets are usually listed in order of liquidity. Liquidity is the ease with which an item can be converted into cash. Current assets are vital to the survival of a business because they provide the funds needed to pay bills and meet expenses. Non-current assets or long-term assets consist of plant and equipment. Companies also often use a category called other assets, where the company lists assets that don't fit in the other categories. For instance, Microsoft included other assets in its 2022 financial statements: long-term accounts receivable, financing receivables, and deferred tax assets. Current liabilities are the debts that must be paid within 1 year. They're usually listed in order of priority of payment. Management must ensure that funds are available to pay current liabilities when they become due in order to maintain the firm's good credit reputation. Long-term liabilities are debts of the business that are due more than 1 year in the future. Although repayment of long-term liabilities might not be due for several years, management must make sure that periodic interest is paid promptly. Long-term liabilities include mortgages, notes payable, and loans payable. At the beginning of this video, I mentioned that classified financial statements are prepared so that it is easier to compare companies' KPIs or key performance indicators. It would be difficult to calculate the current or quick ratio, for instance, if the companies did not classify their assets as current assets or property, plant, and equipment or other assets. Financial performance ratios are typically classified by either profitability, which is a return on investment, such as, for instance, gross margin, return on equity, and return on assets. Another classification is liquidity, and the current ratio, the quick ratio, cash ratios, and working capital ratios are examples. Third category is leverage, which is debt to equity ratios, debit to capital ratio, debt to assets, or operating or efficiency. And then the fourth category is operating or efficiency ratio, which includes inventory turnover, asset turnover, and AR turnover. Here's some of the most common ratios that companies use: the gross profit percentage and margin, current ratio, quick ratio, also called asset test, the cash ratio, working capital ratio, inventory turnover, accounts receivable turnover, and average collection period.